Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, we are recording this only about half an hour before the Fed statement. The initial statement comes out and then the press conference that follows. So we're not going to be focusing on what the Fed had to say or market moves after. We're going to focus on a bit further out. So, Jordan, we were chatting off mic, and you simply made the comment that you think the next 3 to 6 months are going to be very important, not just for the precious metals, but tying it into what's going on with other markets. Let's start with the US equity markets, because that I do think needs to be a focus for everybody, no matter what sector you're invested in. Understanding what US markets could do always has some impact on the other sectors. Jordan, next 3 to 6 months, what is going to be important to watch for US markets?
Well, Corey, the most important thing to watch for will be if the S&P rolls over again and makes a lower low. The S&P at its low in the middle of June, just below 3650, it actually bottomed at the 40-month moving average. And this is a moving average I've been talking about for years, not only for gold, but also for the S&P. If you look at a monthly chart, look at the 40-month moving average. You can go back 100 years. And interestingly, most of the time when you're in a secular bull in stocks, I'm not saying all the time, but most of the time, when the market has a correction or a significant pullback, it doesn't go below the 40-month moving average. Now, since 2009, I think the only time it went below was during COVID, but it rocketed back up really quickly. So aside from that, the stock market is held above the 40-month moving average essentially the entire time. And if you go back and you look at 1942 to 1966 or 1980 to 2000, you can look at that moving average. The majority of the time during these secular bulls, the market has held above that moving average. Now, if you look at when the market fell into secular bears, you can look at after 1929, after 1968, and after 2000. And so those cyclical bear markets, for the first time in a while, the S&P fell below the 40-month moving average. So again, circling back to present, the S&P fell down. It bounced at the 40-month moving average. It's having a rally now. And if you look at I've looked at history of the 6 worst bear markets or 6 bear markets during secular bears. On average, the market rallied up to the 200-day about 7.5 months in, and then rolled over and eventually made lower lows. So the S&P right now is tracking history very closely. So the question is, are we going to see the stock market roll over and make a lower low in the coming months? In September, October, November, maybe. Because if that happens, you're in a new secular bear, basically, for the S&P. Now, if it doesn't, and 3650 is basically the low, maybe the S&P rolls over, but it's able to make a double bottom at 3650. Now, I don't believe this is going to happen, but this is what I'm thinking about as far as a different scenario. But in that scenario, if the market can rebound, and that's the worst is over at 3650, then you're still in a secular bull for the S&P. And then you're not. The reason why this is important, Corey, is because the biggest and best moves in gold and resources, both in the metals and the stocks, they all occurred during secular bear markets and stocks. If you look at, if we just use the gold stocks, for example, if you look at the biggest and best moves cyclically, beyond a period of just 1 or 2 years, all of the best moves were during secular bears in stocks. Now, there was one period, I want to say 64 to 1968. That was one period where gold stocks and resources did pretty well. They did outperform the market, but you could say the secular bear didn't really start until 66 or 68. So that's the one fly in the ointment here of my analysis. But nevertheless, that's what it comes down to, because if the S&P has already made its bottom, then you're not going to get that big or significant of a move in the next couple years in resources or gold. The S&P has already made the low, and it's going to rebound and make higher highs. mean, in that scenario, you're unlikely to see gold break above 2100. So that's why this is so important over the coming months. It'll tell us what's going to happen moving forward in the big picture. And that's my thinking is we are going to see the S&P roll over and make a lower low. And if that happens, then that's going to open up a really, really bright future for, gold and resources. If not, then that means, well, there's still some more time before that's going to happen because the market, might have another run in it.
Well, Jordan, I think this topic is so important. And we actually had a conversation, you and I, a week or two back, where we were talking about the bull market. And you had said the real bull market hasn't started yet. And I said, well, what about the fact that gold bottomed in 2015 and, it ran up for a couple of years and it's generally doubled since then in price. And then the mining stocks have had several big rallies, not just 2016, but there was short-term rallies in 2017. There was another rally in the fall of 2018 and 2019 to 2020, the COVID run, even the silver stocks ran up into February. And you said none of that matters. And I was looking at it from nominal terms. You said the real bull market is when gold and the mining stocks diverge from the general markets, diverge from bonds, diverge from all of their asset classes, and outperform. That seemed like a pretty simple statement, but I don't think a lot of investors get that, Jordan. So could you, I guess, dumb it down for us? What is a real bull market in gold, and why is what you're discussing about the S&P rolling over so crucial for the overall secular bull market to work out?
Yeah, well, I mean, I use this term real bull market, which means gold is rising and outperforming in real terms, but it's really akin to saying a secular bull market in gold, because for there to be a real bull market, I mean, we could say 2018 to 2020 because gold was August 2018 to August 2020 because gold was outperforming during that period. I think it outperformed in real terms. But when you're in a real bull market for gold, I mean, just simply put, look at its best performance. I mean, the 70s and the 2000s. What happened then? Well, you were in a secular bear in the S&P. Because if you're in a secular bull market for the S&P, capital is flowing into stocks. It's not going to flow into gold. And we have not seen, yes, we've seen good moves in gold, but gold is still at the same place as it was 10 or 11 years ago. And even when gold was up, I mean, gold's at what, 1,700 now? I mean, even when gold was at 2,000, it was more or less the same level where it was 11 years ago when it peaked at 1,900. Yeah, it was $100 or 150 above it. Okay, but that's still over a very long period of time, basically at the same level. So you're in a real bull market. Gold is outperforming in real terms, and it really has to happen on a secular basis. It has to be there for more than a couple of years, and you have gold making higher highs. And also when there's a secular bull market, and it's the same thing with the S&P. Like if you look at history, the S&P has had three really significant breakouts that carried it to higher highs and all-time highs. So you had 2013. I mean, that was a 13-year breakout. S&P has made higher highs since then. You look at 1982 in the Dow, or 80 or 81 in the S&P, wherever it was. I mean, that was another significant breakout where the market was pulling away from the consolidation in the range that it was in for 15 years or whatever it was. You go back and you look at, I think it was 1948 or 1950. I'm getting it confused, but there was a point where the S&P broke above, I want to say, a 13-year base. It didn't quite it got above 29 a couple years after that, but breaking above that 13-year base of 1950, I mean, that was really significant. So, and then we look at gold, and it's the same thing with gold, where secular bull markets in gold has also made really important breakouts. So the secular trend in gold, the secular bull market will be confirmed when gold is able to break above 2,100 and run that much higher. And that's only going to happen if the S&P is in a secular bear market. That doesn't mean that the S&P has to be crashing, because when we look at these secular trends, and then when we zoom in and look at the cyclical trends, a lot of the best performance for the gold stocks, for example, occurred during periods where the S&P was rising, but the S&P wasn't rising to new highs. It wasn't breaking out. Gold and gold stocks were the ones doing that at that point. We've seen the reverse in the last 5 or 6 years. We're sure, yeah, gold stocks have gone up. Gold's gone up, but gold has not made new secular highs. It hasn't broken out to new all-time highs and sustained it. The stock market was able to do that. So I hope that provides some color for everyone. And that's why these secular trends are so important. Because if the stock market does roll over and make a lower low, that's going to signal that it's in a new secular bear, and it's going to signal, okay, everything is ready to go for gold and resources. We're really going to move much, much higher over the next 10 years. But if you tell me that the S&P is still going to outperform gold, the S&P in the next year is going to run to a new all-time high, it's going to sustain it, then I mean, the best we can hope for in gold and resources is, maybe we get a big move up for, 6 months or 12 months, and then it kind of falls back again while the market trades around all-time highs. So that's why the secular trends are so important. And also, when we look at the capital that's been invested, obviously there's very little capital in precious metals right now. And, there's so much more capital in the other sectors. And so that's setting up, whenever it happens, that's setting up for a huge bull market in precious metals and resources, whether it starts now or in a couple years.
Okay, so I think I understand here, Jordan. We really need the U.S. markets to, I guess, fall and continue to have that kind of underwhelming sentiment to it, and gold break out. Is gold then breaking out and holding some of these new levels? Is that what is going to pull the stocks higher? Because we keep hearing precious metal stocks, they're still stocks, and they have been moving pretty much in lockstep for the most part with U.S. markets. You even look at GDX to the S&P ratio, it's been stuck in this same range that it really has been since 2014. That's a long time for the stocks, gold stocks, not being able to really make that much progress against the underlying markets.
Yeah, that is such an excellent point, because if you look at these ratio charts, gold against the S&P, gold stocks against the S&P, I mean, this is something I should have mentioned earlier, but looking at those ratio charts, you can see that nothing has really happened for precious metals versus the stock market. And when you look at what happened in the 70s and the 2000s, you can see that's a real bull market. That stands out because there's significant outperformance there. But beyond that, a couple of things I want to mention. Number one, I see lots of people talking about how cheap the gold, or how undervalued the gold stocks are. That's really the wrong word to use. The right word is cheap, because when people are saying they're undervalued, they look at gold stocks against the price of gold. I mean, we know that the ratios are in the toilet, but there's a fundamental reason for that happening. Okay, if we go back 2 years, look at where the gold price was, look at where costs were. What has happened now? We all know that costs are higher and the gold price is at 1,700. It's not at 2,050 anymore. So the profitability of miners is way, way down compared to 24 months ago. That's why the gold stocks are so incredibly cheap versus gold. Cheap is the right, cheap or inexpensive. That's the right. Don't use undervalued. I mean, cheap and inexpensive is the right term to use, because undervalued implies they're, trading well below where they should be trading. Unfortunately, they're trading where they should be trading based on the profitability, which has significantly declined in the last 24 months. But to your point, Corey, we get into a real bull market when you have the gold price and silver as well. They're making higher highs, every year, every couple years. That's going to help these stocks, stay ahead of cost increases, and they're going to trend much, much higher in that environment. Because I'll give you an example. If we're not in a real bull market over the next couple of years, what happens? Let's say we come out of this recession, we get rate cuts, we get a little fiscal, gold rallies up to 2050 again, silver goes up to 25 or whatever, but that's the end of the move, and then they pull back. And so in a couple of years, it's like, well, we had this good move for 6 months or 9 months, but now we're pulling back again. It's just impossible for these companies to outperform the metals and build value in that kind of environment for an extended period of time. But what happens if we see gold go up to 2050, it pulls back and corrects, then it breaks out and it moves up to 2,200, 2,400. Then you're in a real bull market, you're making higher highs. Yeah, maybe costs are up a little bit, but metals prices are still rising for the most part every quarter, every couple of quarters. Then share prices for all these companies are more or less, they're rising, they're trending higher, they're making higher highs over the future quarters and years. I mean, that's a real bull market. And that's exactly what these companies need, because it's impossible for them to build real value beyond beyond a year at a time, when metals prices are not trending higher over a long period of time.
Well, Jordan, I understand the point you're making that metals prices have come down while costs have gone up, which has compressed margins. But there are people that use the word undervalued, and I've used that word before on the stocks when I look at it in terms of look at where these stocks are trading compared to where the metals prices were last time. And we also had higher energy prices back in 2010 and 2011, maybe not as high as now, but there were other periods of time where costs were going up. That was a big reason in 2010 and 2011 that some of the quarterly earnings reports missed because the same thing happened back then. But the stocks were valued 2 or 3 times higher. Also, when you look at economic studies and you look at where the enterprise value of a company is versus where the NAV is on their economic studies, there's a huge divorce there. And if you just look at ounces in the ground, the way they used to be valued versus where they're being valued today, that's why certain people would say, hey, these things are very undervalued to where they are historically. So what would you say to those comments?
Well, I mean, I think your point is well taken. If you look at, it's so hard to value these companies because it's it's so dependent on the gold price. But if you're looking at price to net asset value, if you're looking at price to cash flow, I mean, I have seen a few charts of large companies and where they're trading at over the last 15 years, and they are at very low levels. They are at like bottom type level. I don't know if we're lower than 2013 to 2015, but they're probably pretty close. So no, I appreciate you mentioning that. I mean, they are, I don't like to use the term undervalued. I just like to say that they are really cheap. But that is a really good point that you made. I would mention 2010, what was the difference? We're in a secular bull market. Gold was making higher highs. So the valuations during that period are going to be a lot higher than they are right now when we're not in a secular bull market. And that's another point. You get into a secular bull market, these companies, and we'll just say junior producers, instead of trading at 5 times cash flow or 6 times cash flow or 7 times cash flow, in a real bull market, they could be trading at 8, 9, 10 times cash flow. That makes a huge difference. But I'm not disputing what you said. I guess I don't know why I'm just a stickler for the terminology, but they are really really cheap in my opinion. But I was just clarifying because we have to be careful looking at the stocks against the gold, those metrics, because they really reflect margins, and margins are they're not that great right now, obviously, compared to 2 years ago. But valuations play a huge factor. And so it's a big, when you're close to a market top and you're in 2010, 2011, huge valuation difference compared to today. But that's why, there's incredible value and potential in this sector, because you're going to get a recovery, you're going to get a rebound. So margins are going to expand and valuations can really, really expand. I mean, that's why you see so many 10, 15, 20 baggers off these incredible bottoms, because you get valuations improve and margins expand at the same time. And then the risk appetite, where these junior explorers, suddenly, they're down 80, 85%, 75%, suddenly with metals prices rising, the value of what they have just goes up almost exponentially. So I'm super bullish on the future. But wrapping it all up, yeah, it comes down to the stock market. And it's like the worse the bear market is in the stock market, the better it is over the long term for gold and resources. So everything that's happening is good for gold and resources. So I not that I'm betting on some horrible bear market, but it's so important what happens over the rest of the year. And if we roll over and make lower lows and lose the 40-month moving average, because that is the signal that we will be going into a secular bull market in gold and hard assets. And that it's going to make things so much easier than they've been over the last 5 to 10 years.
Yeah, it has been tough. And again, to the point about valuations, whether you want to say it's undervalued or cheap, the band gets stretched to the downside and to the upside. It's just unfortunate that we're in one of those stretch to the downside. And quite frankly, it's not that a couple companies are not getting value for what they have in the ground. It's everybody not getting value. So you need to balance that out with the whole valuation metric as well, because look, there just isn't any value for ounces in the ground right now. That does change. We just don't know when it will change. But Jordan, you've outlined that the stock market is what we need to be watching. Good chatting with you, Jordan. It's going to be an interesting rest of the day as the Fed news comes out and the Fed rate hike, to see how these markets will undoubtedly be volatile on the back end of that. We'll chat next week, though, Jordan. I hope you have a great rest of your week.